I think it's time to get started here. Welcome everyone to the webcast co-sponsored by Staker Fisher Edwards and Green Apple and Atlantic Management Company entitled Internal or External Ownership Transition, What's Your Final Answer? Hoping to give you some good content today and sort of touch base on a couple of different concepts and ownership transition options in the hour we've allotted. I'm going to quickly introduce actually I'll turn it over to you, John, first to introduce yourself, and we'll come back here. So John Murphy with Atlantic Management Company.
Yes, this is John Murphy, and as Tabitha said, with Atlantic Management Company, we are a valuation and financial advisory firm located here on the seacoast of Portsmouth, New Hampshire. And I'm not sure where everybody is today, but it's a beautiful day here on the seacoast. Tabitha?
All right, and myself, I'm Tabitha Croscut. I'm the managing shareholder of Staker Fisher Edwards and Green Apple. We are a boutique ESOP law firm working with many different companies across the U.S. on ESOPs as a succession or an employee compensation strategy, and always love to have the opportunity to find our colleagues in the industry to present with. So thank you, John, for joining me today.
Sure.
Just some quick administrative announcements here. One is we're going to push questions to the end. We have a number of people on the line, and it's kind of hard to manage on a webcast the questions. So everybody is currently muted, so we can't hear you, but you can hear John and myself. At the end, I will certainly unmute the line so that we can take any questions that might be out there. Feel free also, if you want to use the chat feature on ReadyTalk. We will do our best to monitor it and hopefully at the end answer anything that comes up. So if something comes to your mind along the way, feel free to type that in if you're a tech-savvy person and want to do that. The second is this webcast will be recorded. Currently it's being recorded, so if you want to go back and listen to it, it should be up on the SES Advisors website, which is our sister company, and we'll certainly make it available for Atlantic Management to put that on their website as well. And then you can access it when you want. And if you would like a copy of the slides, just email either Alice, who you got some emails, I believe, from with the information for this webcast, or myself or John, and we will certainly make those slides available to you. So with that, I'm going to turn it back over to you, John, to get us started.
Sure. And today's agenda, as Tabitha started to talk about, is the ownership transition process and alternatives. And so the goal of today, and we only have just the 1 hour, but the goal of today is to discuss why exit planning and transition planning is important. And a lot of it is very common sense to a lot of folks that are in the business, but not so much for the business owners. And secondly, then also talk about what we believe to be the 4 most common transition alternatives that we see in today's world that are the most applicable. And that will involve, I'll be discussing the external buyers, and then Tabitha will be talking about what's commonly referred to as internal buyers. And so with that, we'll just jump right into this. And as we look at this and we look at ownership transition, what is the challenge that's faced by business owners? And one of the challenges is that all businesses, they're either going to be sold at some point, they're going to be transferred, or they're going to be ultimately closed down and liquidated. So whether they're sold to a third party, sold to an ESOP, they're gifted to children, sold to management, or something along those lines, they're going to be transferred at some point in time. Or the businesses, particularly for lifestyle-type companies and lifestyle-type businesses, they're going to be run until such time as the business owner just doesn't want to own and run the business any longer, and they just close it down. The challenge for business owners, for most of them, is that there just is no ready market for their company. So whether it's a law firm like Tabitha's or a financial advisory firm like ours or a manufacturing company or anything, there is no ready market for that company. And so as opposed to owning stock in a public company where I can go out and buy and sell stock with a pretty simple click of a button on the internet or calling my stockbroker. I don't have that ability to do that when I own a privately held business, and that presents the challenge. How do we get liquidity for the ownership stake we have in the company, whether it's a minority interest or 100% control interest? And then lastly, if the goal here is to sell the business, again, whether it's to management, an ESOP, or a third party, how are we going to generate and how are we going to ultimately get, we use the term here fair value. I mean, the term fair value is not, we don't want to get hung up on that term per se, but how are we going to receive value for all the hard work that we've done over the years? So going back to the why plan, the very first thing here, and there's a myriad of steps and checklists and formats and processes to follow when you do an ownership transition plan. And there are lots of different folks that can help business owners with this, and they'll all go about it slightly differently. But at the end of the day, some of the more common themes here in terms of why plan is that first and foremost is we have to understand whose interests that we're going to be taking into consideration. Is it just the business owner? Is it the management team? Is it the employees? Is it the family? Usually it's a combination of all of the above. And it does impact when we're planning and why we're planning. It does impact how a business owner organizes and operates their company. And what I mean by that is it's not so much who I am working with in terms of a vendor or who I'm working with in terms of my advisors, but rather if I know I'm going to be starting a transition plan, and ideally, as we'll talk about, it's always better to start early. But if we're going to be talking about a transition plan, we want to start organizing the company, organizing our contracts, organizing our financials, meaning that if we just use QuickBooks, I say we, the business owner, if the business just uses QuickBooks or Quicken for the financials, it may now make sense to work with the accountant to actually have reviewed financials put together, not necessarily audited, but at least reviewed financials. And if there's a lot of contracts that are in place or leases and they've not been renewed and it's pretty loose, this is what we're talking about as far as organizing the business, because any buyer, particularly an outside buyer that's going to come in, is going to want to see all this information, and the time to try to organize and put it together is not when the company is actively on the market. We talk about here proper planning. Why plan? Because proper planning will save time. It will save money. It will definitely keep the process a lot more organized. And for most instances, saving taxes or minimizing taxes is a paramount feature of what we want to do when we're doing our planning. And so by doing the planning and doing for the transition will definitely help. We talk about estate tax liability. That kind of goes part and parcel with doing the planning aspect of it. And then lastly, if as a business owner we do the planning, we go through this, we work particularly on this side of it, we work with our accountants and our financial advisors, we are going to have as a business owner more dollars that are available for our beneficiaries and heirs, whomever they may be. We're not going to, proper planning, the business owner is not going to have a lot or incur a lot in terms of taxes on the transition, so therefore there's going to be more dollars, more value that's going to be available for the next of kin, the beneficiaries, etc. We talk about how early should somebody start the planning. It's never too early. It's sort of like in real estate, you think about location, location, location. You buy a home with the thought of how easily am I going to be able to sell this? Well, it's the same thing when you have a business. We're looking at, as a business owner, they should be looking at transition, even if it's not going to happen for years down the road. The planning process is something that should always be done early, and quite frankly, for those folks that are on this call today, you are thinking about the planning process right now. And one of the big elements here is now the right time to transfer ownership. And I'll talk about this in a minute, but if I'm looking to sell, if I'm a business owner, I'm looking to sell the company, and the economy is down and valuation multiples are down, and I know that the only way I'm going to generate liquidity and sell and transfer this business is through an M&A process, now may not be the right time to sell. And conversely, on the other side, if the market is very, very strong and valuation multiples and merger multiples are up, is now the right time to sell? Sure. I mean, on one hand, we're in a market where valuation multiples are increasing, but we're also in we used to say an historical low interest rate environment, but it's been this way now for a number of years, so we don't know any longer what the norm is. But so if we're looking to try to do a transfer and we know that there's going to be debt that's involved, and as a business owner, I'm going to have to hold seller notes. Well, today it makes it easier for a company to pay those notes because we're in an environment where we have low interest rates. What's important in terms of considerations? How important is it to the business owner, for their employees, for their community? For instance, if I'm the business owner, am I just simply looking for dollars and I don't care who the buyer is? I want to get the dollars. I want to move on to Tahiti and sit on the beach. Or am I really focused on what my legacy is, or our legacy if there's more than one shareholder in the company? And we really want to do right by the employees, right by the community, with the vendors, and I want to have a lasting legacy. The company name, in my case, Atlantic Management Company. How important is that to me to have that continue on when I decide it's time for me to transition out of the company? And lastly, the planning under ownership transition and the considerations is that it's very helpful and it's very beneficial to control the timing of the succession and transfer, meaning that if I'm busy constantly running the company and the business owner is running the business on a day-to-day basis and not really thinking about anything other than strategic issues related to operations, they'll find themselves all of a sudden one day go, okay, now it's time to make a transfer, and they've not done any planning. And for some of the slides or some of the issues we just talked about, none of that's going to come to fruition because they've not been focused on it. Some of the other elements here on the considerations are, what do we want, what's the role of our family members? If we happen to have family in the company, can they take over the business? Or as a business owner and a parent, am I looking to take care of them financially but outside the company? In today's world, there's a lot more emphasis being placed on helping and working with employees, and particularly key management, providing them incentives and benefits. And Tabitha will talk about this a little bit as she gets into the discussion of ESOPs, but there's more, and there's statistics out there that say for when we're dealing with ownership transition, back many number of years ago, the focus was just purely on the financial outcome of it. In today's world, there's definitely more emphasis being placed on whether it's the philanthropic initiatives of the business owner or just the recognition that as a business owner, I wouldn't be where I am today but for the hard work of the employees and the key management team. So we want to take care of them as well. I touched on a moment ago about the current market and economic conditions. That definitely plays, and it's paramount. It plays in the decision as to, the type of transition that I can consider in today's world, and whether or not I should do it now or whether I should do it in a few months or a few years. That definitely is a very, very factor, and quite frankly, a factor that none of us can control. It's beyond our control. One of the big elements here, and this comes into the different types of transition strategies we have, is it important for the business owner to be able to walk away from the business, sort of just walk away from the blackjack table and you clap your hands and you're done? Is that important for the business owner to be able to walk away with no guarantees, no ties, no seller debt, no anything? If that's an important factor, some of the transition strategies that we'll talk about today are not going to be applicable. And so then it's going to bring us down to another different type of transition strategy. So just understanding where the business owner was there with those elements is going to be important. And then probably the last consideration, and there's many, many of them, but the last one here on our slide is what is available here in terms of what's the certainty that I'm going to have a close. We know that doing a gifting or, in many instances, management buyouts is a fairly straightforward exercise. But on the flip side, selling to a third party is a much more difficult process, and now we're introducing some element of uncertainty in terms of the closing. Some of the mistakes, and this is sort of where we look at, what are some of the mistakes to avoid? Well, the first one, in my mind, is what we dubbed here at the office the ostrich approach, meaning you're going to put your head in the sand, think everything is going to be fine. Years down the road, when it comes time to do it, you can just flip a switch and everything is going to be fine. And as we all know, hopefully you all know, that just simply is not the case. So don't procrastinate. Don't put off and avoid decisions. I'm not sure if there's any insurance folks here on the call, but and also don't assume that insurance is going to take care of everything. Meaning that I'm just going to continue to run the business, and then at some point in time, upon my demise, the insurance money is going to take care of it, and I don't have to worry about it. While it's definitely helpful, it's certainly not the solution to a transition of a company. Again, one of the big points here is assuming all companies are saleable. One of the examples we use a lot of times with clients is many construction companies, and I just picked that industry because it's one that we work in a fair amount, and it's something that it's an easy one for everybody to understand. Many construction companies are not saleable on the open market to a third party. While some transactions do take place, the rolling stock, the equipment, the vehicles, things of that nature are definitely saleable, but the actual company itself, because in many instances in the construction world, the way that the business is generated is on a bid process. And while we want to think that as a business owner in that world, we want to think that the quality of the work that we do comes into play, from a consumer of the services for the construction industry, I'm going to assume that all of those types of companies are going to be able to provide good services, so now it comes down to a price. So if I'm a competitor, rather than buy a company, I can just let them close, and it's just one less person to compete against when I'm doing my bidding. So don't make the assumption that all companies are saleable. Also, don't go into it with a sort of a narrow tunnel vision approach and just assume, yes, absolutely, the management buyout is the only way we're going to go. It definitely makes sense to explore the different options. And then lastly, what we say, transferring ownership to the wrong people. I'm sure Tabitha can give you war stories. We can give you war stories. We have been involved in situations where the parents using this as an example, parents decided to make a gift of stock to their children. And as my father, who recently retired from our company, used to tell me, you got to make sure you can trust your children. And there's situations that we've been involved in where the parents gifted the stock to the children, and once the children got the stock, the next thing they did was fire the parents. So you have to be able to make sure that you're transferring ownership to the right people, or the people that can take over and do a good job with the company. There's going to be one slide here. This is the only slide we have on business valuation, and it's not obviously to talk about value, but more, why is it important in the ownership transition process? And the biggest element here is it does give business owners a realistic view of what the value of their company is. And I'll tell you that it's very, very common for us to see that business owners think that the value of their business is worth more than it truly is. And they want to get paid for a lot of the sweat equity they've put into it. And so firms like ours will come in and believe and identify what we believe the range of value is for the company. And that's one of the very first steps that we want to do in the transition process, to help just kind of set that expectation. It also helps identify some of the detractors to value, and on the flip side, some of the drivers of values, so where some of the benefits are. And then again, at the end of the day, it also is instrumental in helping us determine which of these transition options are available. Meaning that if we happen to have a company that's very valuable, then an outside sale may make a lot of sense. And if we happen to have a company that has very little value, maybe a transition within the family makes a lot of sense. So in the context of ownership transition, this is just a pyramid that we had put together, but it's essentially, if you start at the bottom, well, the very first step is just understanding that there's a number of different options that are available to business owners to transition their business. And not one size fits all, and what may be right for one company may be absolutely inefficient for another company. So the goal here is just to understand that there's options that are available. And then secondly, it's just identifying different options. Of the ones that we've identified, understand they're out there, then we want to identify the different options and sort of look at the pros and cons of those as they pertain to a specific company. Next, we want to look and actually evaluate those. And then probably the two most common options that are evaluated is a sale to a third party and an ESOP. A lot of times business owners will go down parallel paths and evaluate both those options. And then after the transition process has been completed, the analysis completed, ultimately, the business owner wants to select one of the transition options to move forward with, and then the process starts in terms of just executing that transition process. But sort of a little bit of pyramid. Again, you start at the bottom. There's a number of things, and you work your way up to the top, and ultimately just select what the right benefit is or the right transition strategy. So as we talked about, I'm going to focus on the external buyers here, which primarily we're going to talk about the third-party sale briefly, and then Tabitha is going to talk about the internal buyers, the family management, and the ESOP. While liquidation or closing of a business is certainly a transition alternative, it doesn't really merit a lot of discussion because it's pretty self-explanatory. So on the external buyers, and when we're talking about external buyers, we're talking about a third-party sale. The primary advantages as we see them is that it helps capture the real value of the company. So whatever we believe the value of the company is, you tend to you're going to get the higher value when you sell to an outside third party. Usually we're going to be able to exit the business more cleanly than we are with, say, some of the internal options, the management buyouts and the ESOPs, because there's the debt that a buyer may need to purchase the company. In the case of a third party, they're going to be guaranteeing the debt, not the sellers in most instances. And in a lot of times, it also provides a career opportunity. So if we've got some key folks that have worked their way up through the company, and an external buyer comes in many instances, they're going to want to keep those individuals with the company. And so they may have been a vice president or executive vice president, and maybe it makes sense for them to step up and assume the role of president. So they definitely can provide some career opportunities for folks. On the flip side, sale to a third party can be a very lengthy process. There are deals we've worked on that are much shorter, and there are deals we've worked on that have taken years. But it can be a lengthy process, and the due diligence and negotiation process, it can be and oftentimes is stressful. And regardless, we tell the business owners and clients to just focus on running the company. We'll be in touch with you when we need to be. They tend to get bogged down with a lot of the due diligence and negotiation. And keeping in mind that due diligence negotiation from the perspective of buyer is to try to find all the bad things there is to know about the company. So it's not, once they find all the good things, it's not as if the buyer is going to come to the seller and say, boy, you've got a wonderful company. Here's all the great things that we think about it. Because the seller then is going to turn around and say, well, you should pay me more for the business. Their goal, buyer's goal typically in due diligence is to find out where all the bones are buried and all the skeletons are hidden. And then there are some times when there's some post-transaction contingencies, meaning that if there's warranty issues or what have you, there may be some issues there that a business owner may be on the hook for 12, 18, 24 months. There's two types of external buyers, strategic buyers and financial buyers. Strategic buyers a lot of times can be companies that are within the specific industry. It can be a competitor. A lot of times it may be a company that's owned by a private equity group. More times than not, it's definitely a company that the business owner already knows or is aware of. The financial buyers, a lot of times folks in the industry will consider financial buyers oftentimes either individuals or private equity groups. They are not necessarily focused. The one difference with financial buyers is they're not bringing synergy to the table, whereas if two companies in the same space are coming together, a lot of times there's some synergy, and maybe it's going to result in an elimination of redundant positions, like we don't need two HR directors or two controllers or CFOs. A financial buyer oftentimes doesn't bring that to the table. And so the financial buyer is really looking at what the future cash flows of the company are. They're going to be looking at where the company's been and what they think they can do with the business. If it's a private equity group that ultimately is the buyer, they're not in the business to own a business for the long term. The majority of them usually have anywhere from a 3 to 5 or a 3 to 7 year ownership horizon. So they're going to own the company with the goal in 3 to 5 to 7 years flipping it oftentimes to another private equity group. And lastly, when you deal with private equity groups, more times than not, there may be some element of financing that the seller may hold. Usually much more, it's more common with a financial buyer than it would be in the context of a strategic buyer, say a company within the industry, within the space. Buyers, and this really is no different. The top piece here of this slide is no different than the internal buyers in many instances. Usually the consideration for the company is either going to be cash or stock or some sort of a seller or promissory note. One of the differences here when you're dealing with mergers and acquisitions is that the buyer of a company a lot of times is going to have a little bit more protection for themselves, and that's going to be in the form of either what we call earnouts, meaning that I will glad you as a buyer pay based upon the company hitting a performance level of X number of dollars, but I need to see the company do it first. And so a lot of times there'll be a piece of the purchase price is paid in cash or stock, and then there's an element of the purchase price that's paid once the certain performance levels are hit. Holdbacks and escrows a lot of times are just there for contingency reasons, meaning that there's, like as I said earlier, warranty issues. And indemnifications, and this is where the attorneys get involved, and I know Tabitha's an attorney, so she can chuckle at me, but this is where the attorneys get involved and really earn their keep in terms of just what do the sellers have to indemnify the buyers on, and vice versa on a going forward basis. This slide is probably, once an ownership transition determination has been made, and in this case we're talking about a sale to a third party, this is probably one of the very first elements that we'll talk to a client about. And understanding that price and terms are the two most paramount issues to think about. And we always tell clients, do not focus on what the purchase price is, focus on the terms. What I mean by that is a $5 million price in cash is not equal to a $5 million price that has cash, earn-out, and seller notes. So we always tell clients, don't necessarily focus on the price. It's not so much what you make, it's what you keep. But focus really on the terms. How long is it going to take me as a business owner to get those dollars, get those sales dollars? We want to talk to them about structure. We want them to understand what the difference is between a stock sale and an asset sale, because there's some significant tax ramifications that obviously we're not going to get into today, but there's significant tax issues that are involved depending upon the nature of the type of the sale, whether the company's a C Corp or an S Corp. We also want them to understand the timetable. And again, as we alluded to early, a sale to a third party, particularly if the company is going to go through a full auction or market process, is going to take time. And it's reasonable to assume that if a client comes to us and it's a company in the $5 to $10 million range, or up, it doesn't matter, but just using it as a lower end of the market, you're looking at anywhere, say, a 6 to 12-month process is a reasonable expectation, with 6 months, quite frankly, being a little bit on the quick side. And then lastly, on the fees, we just want clients to understand what the fees are. I mean, there's going to be advisors that are put in place to help with this transaction, and we want them to have an understanding of what the overall costs are going to be before they agree to actually go through this process and sell the company. The last external buyer, and quite frankly, we're not going to focus any time on this, is IPO, initial public offering. As many of us know, I mean, it's basically taking a private company and going to market and ultimately becoming a public company. It is suitable for the high growth companies because the market makers for this type of a transition element is definitely going to want to focus on return. But as we all know, and we have the data that shows it, I mean, the number of companies going at the IPO route and going public has really been down the last couple of years for various reasons, but the biggest one is just the economic conditions, and up until the last number of months and what have you, the market itself was just not strong, and so companies didn't necessarily want to go down this path. So that's sort of just a snapshot of why do business owners, should they consider the ownership transition planning, what some of the alternatives are available to them, as we talked about what they were, and then that was just a snapshot of, say, the third-party sale. Tabitha's going to take it from here, and she's going to focus on the internal pieces to include the ESOP. So with that, Tabitha, I'll turn it over to you.
Thanks, John. So as John said, I'm just going to go through the various internal buyers that were outlined And we're just going to start with sort of a conceptual approach here. Internal buyers, and as I was listening to John speak, it struck me that one of the advantages, I think, to the internal buyer options is that we see many times that you may have the opportunity to use multiple options. So you might see an ESOP paired with a management buyout feature. So they're a little more malleable in terms of using whichever options are most appropriate to meet the objectives. But the key with the internal buyouts is that they generally are approaches that are using company cash flow to handle the purchase of the stock. And so you don't have that third party coming with a pocket of cash to throw at someone at closing. That company really is going to be generating the cash flow to accomplish the ownership transition. So you're really, as a company, the company has to focus on where is that cash flow coming from. Are they diverting profit sharing? Are they giving additional bonus compensation, perhaps to management, to fund that purchase? Is there some sort of salary continuation agreement in place for that selling shareholder owner? So that you're really more focused on what is the future cash flow abilities of that company when you're looking at internal buyers. So a common one and one that either applies or doesn't apply, it's really one that you can go down your checklist of options and say, is there family members around? Are there children in the business that want to take over the business? Is it even something that an owner wants to consider? That of selling or gifting, depending on the ideology of the owner and the family. What do you, the owner, want to accomplish? Do you really want to deal with, in some cases, the family dynamic? So there are some companies, some owners who would look to sort of gift, just transfer the ownership. Other owners who are more interested in making sure that those family members have paid. And so it comes back to a question of what is an owner looking to get out of the ownership transition. And John had mentioned, philanthropic tendencies for some companies and owners. So again, really focused on the objectives of that particular company and the ownership. There is at times some tension between liquidity or reward for the senior generation and then the opportunity for succeeding generations. So it's not uncommon to come across a company where the father may or mother wants to get a significant price tag for their stock, but what does that do to the succeeding generation in terms of their ability to continue on with that company? Is the company able to pay for it? So a lot of dynamics in the sale or gift to family members, and a lot of times, of course, that is the objective is placed in the estate planning features of it as well. The second one, management buyouts. This seems like a logical place for a lot of companies. Management wants to be the next one stepping into those shoes. The problem is always the cash flow. Has management, has the team, the executive team, saved the funds necessary to make that purchase? And most of the time they haven't, and so again, you're looking at cash flows of the company. And then the next step is, well, is that sufficient for the business owner? What are the terms of that transition? And we've all heard the horror stories and seen the horror stories in which management steps up and wants to acquire those shares from the business owner, and they work out the details and the terms, and then 5 years out something happens and the business owner has to step back in and take back that ownership, and that's really the last thing we want to see happen. So it's a good option for some companies. I think it's really good also when paired with other options. We've seen it in quite a few situations with the ESOP purchase, where we're doing not a 100% sale of stock to an ESOP. You might see, ownership, the management team holding maybe 5% or 15% or what have you of the ownership of the company, and the rest being transitioned to an ESOP. Or you could see management and a gifting strategy. So it really depends on what's available in terms of cash flow. And so that, these internal options are really specific to the needs and desires of both the company and the business owner going forward. What are the needs there? Many companies, especially the service companies, have a redemption or a buy-sell strategy. This has often been negotiated early on in a company's life cycle, and so 2, 3 founding owners may have put together a buy-sell. They may have insured that buy-sell, and so there's this redemption program in place. And we see this a lot. I'm sure, John, you've seen it plenty as well in terms of having a buy-sell in place, but then finding out that the tax implications of a buy-sell or redemption program really are terrible in comparison to the tax efficiency of an ESOP transaction, for instance. So it is not unusual to have a company who's been set up with founding owners, multiple owners, with a buy-sell agreement, and that is really how they were intending to transition ownership over the years. And then they learn about ESOP, and at that point it's time to terminate the buy-sell and go with the ESOP. We also have companies that continue to have a buy-sell in place for many other reasons, and then have a minority or a majority ESOP transaction, and the shares that are held outside of the ESOP are really structured for transfer under the buy-sell agreement. So again, you may have multiple options on the internal buyer spectrum. And so going from gifting to management buyout to this redemption or buy-sell scenario, we go into the area that I love the most, which is ESOPs, as a very tax-efficient shareholder or business owner-directed process, with, of course, the caveat that we're not, going under the terms of a buy-sell. We're in a much more complex area that's regulated by the Internal Revenue Code and by ERISA, and so it is a much different world to that of just structuring a buy-sell or doing some share transfer documents for a gifting strategy. It really is its own sort of third-party sale, but with some other regulation. So the typical goals of the ESOP transaction, and I just want to step back for a second and just sort of summarize sort of all of the options that John talked about with a third-party sale, with private equity, with IPO. Any strategy you look at, you really first have to start with what John was talking about, looking at a plan, whether it's a really, really detailed plan for transition or a short plan, whatever it is. You really got to sit down and figure out what are the objectives, what can the company handle, what is available, who are the really important players here, and what is the business owner trying to accomplish. Starting with those concepts and figuring out the dollars that are needed or available, then you can really hone in to which options are truly available for each particular business owner. And that the option may not be the same for 2 owners in one company. They could be very different depending on the goals. So the typical goals of the ESOP transaction that we've seen are obviously shareholder liquidity. The ESOP is really creating a market. As John had said, many companies, there's just no market for the sale of the company. It is certainly a long-term ownership transition plan. You can sell shares over a long period of time, and so it offers much more flexibility and can meet a lot of different goals that some of the other strategies would not be able to fill. And generally, on the top of the list is corporate and personal tax planning. As I said, the ESOP offers a very efficient tax advantage to both the company and the individual selling shareholder. So just a quick list of why business owners use ESOPs, the top 3 being what John had talked about, legacy at the top, employee concern, really giving back to the employees, and control. And the term control has a lot of different meanings for different people, but I would also say that that is one of the key points in terms of looking at the different options, because the amount of control over sort of day-to-day and over governance of a company is different depending on which option you choose. You sell to a third party, obviously you lose control. You have no idea what's going on with the company in the future. You sell to private equity, you're also in a different place. You sell to an ESOP, you maintain that day-to-day control. And so I think that's another one of those objectives that you really have to wrap your arms around to figure out which option is best for the business owner. And then these other objectives on the list are just some we've come across. Diversification, reducing income tax, increasing employee productivity, and I'm not going to go into all of them. I want to make sure we stay in our time here. So the ESOP benefits, seller might be able to avoid paying tax on the sale of company stock. This, of course, is something very specific to ESOP. It's available in C corporation context, and there are a lot more details there, but it's certainly something that you're not going to get with the sale to a third party or to private equity and the like. You may also have the ability for the company to pay little or no corporate income tax in the S corporation context, and I'm going to touch on that in the next slide. There's this deductibility of the loan interest and principal, whether S corp or C corporation. This is the feature that the ESOP brings as its retirement plan feature. So you're able to use, the company is able to use pre-tax dollars for the purchase. So when you compare that to just straight redemption or purchase of stock by a company versus the ESOP, that's where you really get your tax efficiency, is the use of deductible dollars versus after-tax dollars. Again, control of the company in the ESOP, the owner really can continue that control day-to-day, in some instances also in terms of governance. The transaction structures are very flexible, and I find that some owners we work with are actually overwhelmed with the flexibility. And so it can be a good thing, and to some it can be a bad thing. But it does allow you to sort of pick and choose how much stock you want to sell as an owner, whether that's 1%. We have companies that are selling 5% each year, or they're just contributing that each year. Others go immediately from 0 to 100%, and really going to get that S corporation tax exempt status. And you can sell over a period of years. I had 3 brothers who owned a company, and their strategy was, let's sell a third. Every 5 years, we'll sell a third of the company to the ESOP. So it really is a flexible tool. It allows employees to keep their jobs. That's huge for a lot of companies. That may be the biggest or only employer in a community, and having a strategy that allows the owner to get some tax benefits but also allows employees to keep their jobs can be a very major motivator for going with an ESOP transaction. And the last one, tool to increase employee productivity. It takes some effort, it takes a lot of communication, but evidence, research has shown that ESOPs are definitely useful in increasing employee productivity. So the different significant tax preferences, I just touched on most of them, with the deduction of principal on an ESOP loan. I'm not going to go into these in great detail, but there's this 1042 option with the C corporation, which allows the selling shareholder to avoid potentially forever the payment of tax. And with our current capital gains rates, this I think is a huge motivator for many people, and will continue to be so in the coming years. There's also the ability to deduct the dividends that might be paid on the ESOP shares, and that's just one of the tools that we use in order to maximize the tax preferences in an ESOP transaction. It's the only place in the Internal Revenue Code where you're going to find deductibility of dividends. And then the S corporation, which I believe is the next slide. So what I'll call the mecca for our ESOP company is the ability to sell stock in an S corporation to an ESOP, and as a tax-exempt shareholder, the ESOP's ownership percentage of the company avoids tax. So a lot of companies the past few years have really gone from a 0 to 100% ESOP ownership structure with the intention and ability to avoid the payment of all their federal income tax because the ESOP does not pay tax. So you have a lot of S corporations with ESOP ownership who are being able to use those dollars that they are not paying to Uncle Sam anymore to grow the company, acquire, pay off the ESOP debt a lot faster. The downside is there's no 1042 deferral in an S corporation. There's no dividend deduction, and the contribution limits are a little lower, but we are able to really structure a transaction to maximize that tax-free ESOP position for companies and increase their cash flow. Just doing a quick comparison, just to kind of prove a point based on the objectives of the selling shareholders or the business owner. Looking at a management buyout versus an ESOP buyout, just looking at the tax impacts, and the management buyout tax will fail to the sellers. There's no way to avoid that. You're going to pay capital gains taxes. On the ESOP buyout, you may, if you're in a C corporation context, you may be able to defer that tax with a 1042 election. The dollars used for the purchase in a management buyout, you're usually using the cash generated by the company, so you're talking about using after-tax dollars to really help fund the management buyout of the owner's stock, whereas in the ESOP, you're going to be using pre-tax financing. You're going to leverage the deductibility of the dollars to be able to use pre-tax money, which is a huge boost for the cash flow of the company. And then, of course, it's a question of who do you want ownership to be in the hands of. If ownership is you're looking to just benefit a few people, then the ESOP is not the right strategy, and that happens a lot. If the first question is we don't want a rank and file, all employees to hold stock in the company, then the ESOP buyout is not the right strategy. Then management buyout might be the more appropriate way to go, or you might do a mixture of both. This is just a quick list of how does an ESOP work, sort of from A to Z, how do we get from no ESOP to an ESOP purchasing stock, and just a quick summary. The company establishes the trust actually purchases the stock from the shareholder, and depending on where the financing for that transaction comes from, might come from the bank, it might come from the seller providing some financing, and then on an ongoing basis, the company is going to make contributions or they're going to pay dividends to the ESOP, and that's what the ESOP is going to use to repay either the debt to the bank or the debt to the selling shareholder. As you go forward, the company or the ESOP will repurchase the shares as people leave and are paid their retirement funds out of the ESOP, and so that's sort of the life cycle in about a 2-minute, if that, in a 1-minute summary, just to give you the concept. There are 3 slides on here with structure. I don't want to spend a ton of time on this. I just want to sort of give you the picture. But this is the C corporation typical structure. There's a lot going on this slide, but basically following the bank providing cash to the company then issuing a note to the bank. The company then puts that cash into the ESOP. The ESOP is, of course, then going to owe the company, and so there is a note there between the company. And then the ESOP is going to pay that cash to the shareholders in exchange for their company stock. There is an arrow on the left that, see if I can point it out here, This is the possibility that there might be a pledge of the QRP, that is the qualified replacement property deals with the 1042 election, and that's why this is the C corporation structure. You can only get the tax-deferred treatment in a 1042 transaction, and the QRP is purchased with the proceeds from that sale. So just to throw that out there, hopefully not to confuse you too much, but this is the C corporation structure. Next slide talks about the S corporation structure. It's a little different because in the S corporation, you may have a structure where the shareholder can actually sell a portion to the company and a portion is purchased by the ESOP directly from the company. Again, these are sort of the typical structure, but there are so many ways in which to structure an ESOP transaction, including throwing in some management buyout features, that there's no one-size-fits-all in terms of ESOP transactions. They are very flexible, and the goal is to structure them in a way that meets the goals of the company and the selling shareholders and any other parties involved. So these are just to sort of give you a flavor. And then the last pictorial here is a picture of what happens on the repayment. So the ESOP makes these contributions, or I'm sorry, the company makes these contributions or dividends to the ESOP, which the ESOP is then going to use to repay its note to the company. And then the company is using those deductible dollars to pay either the bank or the shareholders. And then what happens down here is a release of shares inside the ESOP. I'm not going to go into the details of that because we don't have time, and that's sort of a more ESOP-focused concept. Just to point out, this slide just points out that ESOP ownership is, for the employees, a beneficial ownership. The employees of the company do not become outright shareholders. They become beneficial owners of the stock held by the ESOP. So you don't typically see employees of a company departing for whatever reason and taking stock certificates with them. They are paid out in cash, and the ESOP continues to hold the stock. Just a quick slide about ESOP provisions, remembering that in ESOP, the power of the ESOP is provided because it is a retirement plan. It's a qualified retirement plan, and so it has an allocation formula within the plan that says how people are going to get stock allocated to their accounts. It has a vesting schedule just like every other qualified plan, whether that be a 3-year cliff or a 6-year graded schedule. And there are certain benefit distribution timing provisions that companies can design for their own, based on what their objectives are in each particular company. Let's say the best ESOP candidates, I would say that not all companies meet every single one of these that we work with, but the best ESOP candidates are definitely profitable and growing. The worst ESOP candidates are those that have no profits, because if you're not profitable, you're not taking advantage. You are not taking advantage of the ESOP's tax treatment or benefits. A good ESOP company can finance its own growth. It's not over-leveraged, and these are all considerations that are given when companies are and owners are doing transaction analyses at the front end to make sure that an ESOP would not inhibit growth, would not over-leverage the company. A good ESOP company will have good financial reporting because you are going to have a valuation required annually so that the participants would know the value of that stock on an annual basis. And there has to be some good, hopefully good, deep, and broad management in place. The worst scenario is a scenario in which the owner really is the heart and soul of that company, and they sell 100% of their stock to the ESOP, and then a year later leave, and the company plummets because they did not have a succession plan. There was no management team in place to continue the life of that company. So one of the first questions is always, do you have a management team to begin with, and is there someone behind you that can take over in your absence? So a quick non-benefiting ESOP, again, no successor management, no one in place to take over in the absence of the selling shareholder or shareholders. If the owner only wants a few people to own the company, or now you're talking more about management buyout situation. There may not be enough employees to SOP. In some cases, depending on whether you're a C corporation or an S corporation looking at ESOP, in an S corporation there is a minimum number of employees that really needs to be in place to avoid some catastrophic results. So I always use 20, 25 is a good number for an S corp. Higher than that is great. C corporations don't really have any minimum. Owner's price is opportunistic. John was talking to begin with about synergies in a third-party sale. If an owner is looking to maximize the pricing, and this is sort of another webcast in itself, looking at the valuation impact of each of these different succession strategies. But if an owner is looking for the highest and best price, then the ESOP might get you there depending on the company and the industry, but a lot of times you're not going to be able to get to that synergistic value of a third-party sale. And quickly, the steps in an ESOP transaction, we always like to start with the feasibility or transaction analysis to make sure companies, owners, management teams know what the day after the ESOP looks like and the years after looks like. Then, of course, depending on what the financing needs are, we need to talk with the banks or with the selling shareholders. We need an appraisal in all of these events. Going to look at some plan design and as a retirement plan, what's going to meet the needs of the company and be most beneficial. Then, of course, I get to help with the transaction legal documents. We get to closing, and the best part about the ESOP is that it's a friendly transaction, and as John had mentioned in the beginning, there's control over the transaction, so that unlike a third-party sale where you start out the day talking to a third party, expecting to get to closing, you might never get there. The discussion may break down. That rarely, if ever, happens in an ESOP transaction. Everybody knows where the finish line is, and it's just a question of making sure everything's in place to get there. And then the last piece is just getting an IRS determination letter, which is probably the longest part of the process these days, since the IRS offices are closed on Fridays, I've heard. But it's a simple process. So to get started, if ESOP sounds like a great tool for a company, it's the ownership transition analysis. Make sure that the ESOP is right. Do that transaction analysis or feasibility analysis to make sure it does actually get you where you need to be. And then, the advisory team is key in an ESOP transaction. John and I see transactions all the time in which the advisory team put together was not strong at all, and unfortunately we end up cleaning up after folks who went ESOP without the benefit of those who are very familiar and comfortable and know all the rules that come along with the area, which is definitely a complex area. So working with attorney, valuation advisor, accountants and bankers and the like who are familiar with ESOPs, and not just familiar but know the rules and what the DOL and the IRS are looking for is key to having a successful ESOP transaction. And then just to wrap the summary of the ownership transition here is, start with the questions about owner objectives and desires. Does the owner want cash at close? Does the owner want continued employment? What is their tax perspective and position? Are they trying to maximize, keeping money out of the IRS's hands? Or is it not about that? Are they looking for a partial sale or a 100% sale of their stock? Starting with those questions and figuring out the answers will help you to identify which ownership strategies are going to be even available. And the second part, the company situation objectives. Is leverage even possible? Is the company already leveraged? Is there depth in the management team, or do we need to work on a succession plan first? And will the operations continue without the seller if the seller's desires are actually to no longer be employed? So again, figuring out the answers to those questions is going to go a long way in figuring out the strategies. And so with that, I am going to figure out how to open the line. See if this works.
The conference has been unmuted.
Yay! If anybody has questions, John and I are happy to answer them either online right now or offline. Our emails, we're happy to provide whatever information we can to help folks figure out what's right for them. So I'll just ask any questions. Feel free to speak up. Hopefully I unmuted correctly.
Is anybody home?
All right, good. I hear laughter, so that's good. All right, well, it's 1:30, so the slides are available. If anybody wants a PDF copy, please let us know. We will send those to you. The presentation will be available in recorded fashion, so feel free to re-access and listen to it at your leisure or share it with whoever you'd like. John and I are so happy that you guys were able to join us today, and hopefully you learned something new. That's the goal, and we appreciate your time. So thanks for joining.
Thank you.
John, thanks for joining me.
Sure, Tabitha. Have a wonderful afternoon, everybody.
PremiumBeat.com